open, in come the crowds. Good afternoon, everybody. Very nice to see you this afternoon in a sunny London setting for some of us. Welcome to the Edison Morris Adali webinar on activism and activist shareholders. We are delighted to be joined today by fellow host Charles Nelson, who's Managing Director Morris Adali, Emil Kayan, Director of Lazards, Dominic Lagan, who is Head of Investor Relations for TP ICAP, and Tom Matthews from market leading lawyer UK and Europe for activism of White and Case. The session today has been deliberately aimed at corporates, so do feel free if you want to ask questions, as that this is very much a sort of closed environment, and please take advantage of the skill set of the panelists to ask them anything that you feel is relevant. If not now in the session, then certainly afterwards, and we'll be circulating contact details so you can follow up with everybody. Just to start, so I'm Fraser. I'm the Chief Exec here at Edison, equity research and investor relations provider, and the subject of activism is very dear to us. I'm always surprised at how it catches so many professional boards on the hop, when really it shouldn't. It should be very much more a daily part of running life as a quoted companies. You never quite know who's going to get on your share register, and in today's environment, you know, as active shareholders can play a much more dominant part in dictating how a board strategy is executed. So activism is definitely a growing phenomenon in Western equity market. Its sense, it is the definition of a body of shareholders who seek to effect a change within a corporation. While they're not all necessarily protagonists, activist shareholders are all opportunistic, and most are generalized as disruptive, often yielding more power than their shareholding may warrant, while professional hedge funds that pursue an activist strategy are quite often more interested in the trading activity they can secure through a campaign rather than the successful execution of the proposed strategy. One thing's for sure, it seldom ends well for the incumbent board. Even if they see off the protagonists, there's doubts about their strategy, and business acumen can linger for longer in shareholders' minds. Proxy fights are typically long, draining, and expensive. And on top of that, the media can love them. In the last week, we've seen Canadian clothing company Gildan succumb to an activist, and the entire board had to resign. Elliott is said to have built up $1 billion stake in UK industrials company Johnson Controls. ExxonMobil is in dispute with two of its major shareholders after suing environmental activist groups. And Eminence Capital has started to build a stake in UK-listed consumer goods Reckitt. While every activist campaign is unique, they often follow a particular playbook. And so a company's response can be prepared and rehearsed in advance. Companies need to have a strategy to deal with an activist approach. It is important that they stay in control of the news flow and market commentary as much as is possible. They should not let the activists dictate the pace of the engagement. So what we've chosen today is we'll cover off three core phases of an activist approach, how a board should prepare for that approach, whether it does happen or not, but much better to be prepared than be caught on the hop. How do you respond to an approach once it does materialize? And then once the initial excitement is over, then how do you engage with an activist as to how do you make sure that you stay in control of their campaign, and sometimes they may have positive things to bring to the company. So you need to listen and keep that responsibility for all your shareholders. So I'm going to open this up now, just starting with the being prepared. Dominic, can I start with you as a corporate representative on the panel here? What would be your advice to other boards as to how best they can be prepared? How far in advance do you need to be prepared? What's the process that you would go through?
Yeah, I mean, clearly the first thing is to keep a close eye on your share register. Be aware in your market of who the common activists are out there. So keep a close eye on your register. That's not always the answer, because some shareholders can become sort of quasi shareholders by taking out a CFD on your stock, in which case they won't be the underlying shareholder, but they will be in a position to agitate for change. I think really every company needs to be aware of its sort of weak points, and construct strategies around how you would respond to activist activity directed at those weaknesses. So I think companies almost take a step back and sort of take a look at themselves and kind of consider the areas where you are susceptible to challenge. That might be pressure to realize value in an asset. It might be pressure to do buybacks, or if you're running an inefficient balance sheet. It could be a number of different factors to consider. But I think it's taking a long hard look at yourself and preempting those areas that are susceptible.
And Charles, just on the subject of knowing who the shareholders are, this is something that the Maurice Darling team really excel at. What would be your typical recommendations?
Dominic, thank you, Fraser. Dominic's exactly right, is kind of pinpointing your investors in a very detailed way on the register. And if you've got activists, and nowadays there's a lot of kind of swarm tactics by activists. They all have the same kind of research, research teams, and the kind of outputs that they want to get to. They're very similar in a lot of ways. So what you tend to find happening is that you'll get more than one activist coming onto a register because they're looking for the same kind of things. So how do you identify that? And if they do hold their positions in derivatives, can you actually get behind that and find out? It is extremely difficult. It's an art as much as anything. But if you eliminate everything else, you get left with some positions that you can hopefully identify, and you can find out behind groups like the prime broker positions. You can make assessments depending on which prime brokers are on the register as to which potential activist it could be. If it's say a kind of global activist, we look at activists and we kind of rank them in terms of the size and how often and frequency, and how many campaigns they're running, and how successful they are. You kind of end up as a shareholder identification team really understanding which are the likely prime brokers that they might use, and what are the likely kind of candidates for their being their target. So which companies are they likely to target, and what would be their modus operandi once they get onto the register. So it's not easy. You can suddenly find out you've got an activist on the register you have no clue that was there, and they suddenly approach you privately with a demand. But I think it kind of boils down to, it's always worthwhile keeping an up-to-date register analysis, monitoring it, doing it regularly, making sure that all of the kind of potential weaknesses, as Dominic talked about there, have been addressed or are being addressed, because activists will just leverage anything that they see as a weakness to get to the ends that they're looking to get to. So, it might be that they're looking for strategic change, but might attack a company on governance issues or something like that. The share, and it all starts with the understanding of the shareholding base.
Thank you. And Emil, what would you be your suggestions then of the subject of preparation when you're working with clients? Does this come up is this an annual exercise? Is it something you do every 6 months, or do companies suddenly just think, crikey, I'm feeling a bit undervalued, this might be something that we should do? How does Lazar's work with your
Thanks, Fraser. Well, I think that undervaluation point is always a trigger for a refresh. Everyone kind of suddenly recalls the importance of doing this sort of analysis. But typically what we advise is this is a kind of on a full scale basis. This is an annual or every 2 years exercise. But really, this gets updated quarterly. When you go through your results, you go through shareholder engagement. I completely agree with everything that Dominic and Charles have already raised, but I really would kind of further state the importance of understanding the perspectives of your current shareholder base. Activism today cannot really succeed without a broader supportive shareholder base. It doesn't really matter if we're going to run this all the way to a proxy fight, face all the way to a proxy fight. For anything to gain traction with management, it needs to be kind of within the broader shareholder base already. And that's whether it's an incoming activist who has never been a holder before, or, as is becoming more and more common, an existing shareholder choosing to be a little bit more vocal. So making sure that you take the time to run through all of the feedback you get from shareholders, identify any common themes across the shareholder base after results. Actually this quarter there was a bit of an uptick in people asking when we're going to do buybacks, or actually this dividend policy isn't really progressing enough for us. That sort of thing needs to be escalated, and quickly. It is not just a throwaway comment. It's something that we really need to investigate. And to Dominic's point, anything like that can become a weakness or a vulnerability that you need to make sure that you are on the front foot of. Even if you are not going to take the actions that you're kind of hearing are being suggested, you should know why you're not taking them. And then if they are raised by shareholders or an activist, you're ready to respond. I think the key point, and you alluded to this at the beginning, Fraser, is owning the narrative of your company. It shouldn't be something that has just happened and this is the way we've always done it. Having that reflective approach, saying we pursue this strategy because of these reasons, and thinking about it in that way is the best way to be prepared on an ongoing basis. And then when we talk about the sort of, which I think we'll come to when we talk about responding, some of the best practices we have, that sort of drill, as we might call it, we typically do on a less regular basis, but it's easy to reactivate as long as you understand where your vulnerabilities are.
Yes, that's absolutely right. And Tom, from a legal perspective, are there some obvious things that companies should be doing in preparation? What do you add to this?
Yeah, look, I agree. Obviously, agree with everything that's been said so far, and maybe the legal tools pull some of that together. What one sort of macro point to make is that there's been a general trend over the past 2 to 3 years of activists approaching companies with much smaller positions than might have been the case historically. People have 5% in their head as an important number because that's the level at which an activist on their own can requisition a shareholder meeting. But we're seeing activists with much smaller positions writing private or public letters and actually gaining traction. Why is that important? Well, from a legal perspective, the DTR 5 disclosure regulations ordinarily kick in if you're a premium listed company at 3%. So if you're a UK company at 3%, but many fund managers can take the benefit of a 5% initial disclosure exemption. So they can build a position, Dominic mentioned CFDs, possibly outside the register, and build up to say 4.99% without triggering a DTR 5 public filing. So it's very important to monitor your public filings, but be alive to the fact that you might not see somebody that's sitting there at just below 5% who could be about to trigger something, which brings me on to the next legal tool that's available to any English incorporated company. It's a statutory tool called a Section 793 notice. you as a company can send those out at any point in time to anybody that you have reason to believe is interested in or may be interested in, or has had an interest over the previous 3 years in your shares. That's a very powerful tool to help unpick the register. And I would, to pick up on ML's point about how frequently does one think about these things, I would say alongside your ordinary course shareholder engagement timetable, periodically you should be sending out these 793 request notices to your register, to the names that sit on the register, who then have an obligation to pass those down to the beneficial interest sitting behind those names. That's very powerful. That allows you to track movements in the register over time, and maybe can anticipate somebody that might be building a position in CFDs ahead of engagement. The other thing I'd mention is that when people talk about activists, they tend to think about people building a long position. They are therefore a shareholder, and in theory, at least, are aligned with the rest of the shareholder base. There's a particular flavour of activist that you could say is misaligned with the rest of the shareholder base, which is the activist short seller. We're seeing more and more of that in the UK and across Europe. There's some pretty high-profile instances of where actively the short sellers have got it right. So Wirecard being one example, NMC Health closer to home. Nonetheless, they get a pretty bad rep as being opportunistic, but there are some thresholds that trigger disclosures by them as well. And being alive to people building their short positions in your stock is very important.
Tom, can I ask you just from a legal question? Are activists able to coordinate, and I guess collude is the word one would use, before an approach of a company? We spoke a little earlier as to whether you get more than one activist at a time. What's the legal background? I suppose that's probably easy to answer on the UK.
It's a great question, and many activists that are active in these waters hail from the US, where this concept of collusion and grouping has a different meaning. Over here, the short answer is it's actually pretty flexible for activists to speak to each other. The main thing that they need to be careful of is not tripping over market abuse regulation concerns, but that is actually navigable. As long as they're speaking to each other for proper purposes, and to the extent that anything they're discussing is or could be price sensitive, they're not trading, they can absolutely speak to each other, and activists can go and speak to other shareholders as well to road test their proposals, and that can be done in a normal cross basis to give the activist a reasonable degree of comfort that when they approach the company, they're not going to find that the register doesn't like what they're proposing to management. So from an activist side, it's possible. I'll create a straw man proposal here. With 3%, you can write a private letter to the board that says, we believe that, although we've only got 3%, we believe that, one or two other major shareholders would support us, and we believe that approximately X% of the register would fall behind these proposals. And therefore, you're sitting there in receipt of this letter that is, on the one hand, somebody only owns 3%, so why should I care? Well, actually, probably the rest of the register, it may fall in line behind that proposal. So to answer your question, Fraser, it's pretty flexible. People worry about the takeover code, but actually that's a pretty high bar to be considered to be acting in concert. And unless you're proposing to sweep out the board or take control of the board, actually you can 9 times out of 10 discount the takeover code. Right. So then it's mainly market abuse concerns that you need to worry about.
Okay. Could I just kind of chip in a little bit there? Because totally, obviously agree with what Tom's just said, and what we've seen over the last year or so is that activists are doing perception audits quite regularly now. It's kind of almost, I wouldn't say it's common practice, but I think it's kind of regularly assumed that they're going to be doing something like that to get the views of other investors. And we know that traditional investors are much more likely to engage with activists, or at least side of activists, if they're not happy with the performance of the company or the strategic direction the company has taken. So I think this is one of the other things that companies need to think about in preparation, is do your own perception audit. Because if an activist comes to you and, as Tom says, and sends you a letter and says, right, we've got 40%, we believe 40% of the register is behind what what we're proposing, the company's got to be in a position where it really does understand what their investors are thinking at the time. And you've seen, in terms of campaigns like the Capricorn campaign last year, that's exactly what happened. And they were caught off guard, didn't understand what their investors thought, didn't really understand that those investors were backing the activist, and the whole board were kind of voted out on an RGM. So really important to do that. And I think it comes to the second point here as well, is hire advisors at a very early stage. Do not think you're going to be able to do this yourself. You can't. The activists are very well financed, informed. They've done their work already on the company, so they will already have their views on where the weaknesses are. So make sure, as a company, as a board, you hire all the right advisors really, really early on to prepare for all of this.
And Dominic, can I just come in to ask you then, in your experience of companies that you've worked with, does everyone abide by best practice, or are there still, would it be surprised as to how many holes there are in building a proper defence document in advance in London markets?
Yeah, I mean, look, I think your defence document should include, aspects of potential, weaknesses that we spoke about earlier. I think, so you need to be very well prepared from that perspective. I mean, just in terms of other things to consider, I know we're talking a lot about, will a campaign develop, etc. I think in my experience, that's certainly a big risk, and I think looking at feedback is a very, very good tool that ML mentioned to try and pick up those trends. I mean, in the situations I've been exposed to, we've had both a private letter to the chairman, which is, I guess, much easier to deal with if you can keep it in the private domain. So that can actually be quite constructive. We also had a situation where we had a shareholder that owned us via sort of a CFD. We had engaged a lot with this person before, quite a small fund. They sent a public letter, and our approach sort of there was to, and in any scenario like this, I mean, engagement is absolutely key. You've got to treat the activist with respect. Don't be seen to be not listening to your shareholders. That would be not good at all. In our case, in this scenario, we agreed with the shareholder up front that we would continue the engagement in the private domain, which the activist agreed to, which was a great outcome, because then you can have a constructive engagement with the person. And I think you need to have several of those. In our case, with the chairman. But that's absolutely key. If you can agree to keep it in the private domain, you've kind of won half the battle. In our case as well, it was quite a small shareholder that wasn't very well known. So although they did try to get other support from other shareholders, they weren't quite successful. But that's not to say that actually a lot of our big shareholders did agree with a lot of the sentiment in the letter, and they told us so. But again, in our situation, it was things that we were already aware of and actively looking at, at the board level. So again, that made those discussions a little bit easier. But engaging straight away, absolutely key.
Yeah. So for those who haven't been able to join today's webinar, and they're underprepared. The activists have turned up and they've sent the first letter in. Presumably, it normally comes with an approach like that, or maybe it comes, as well. It can come with a public letter. okay, you're in the immediate response. They probably drop it on a Friday afternoon or whenever the worst time is. What's the next step? So I guess over the next, there's probably, the timelines must be 24 hours, 48 hours, and then the first week before you're starting to get into the campaign. So Tom, what is the typical timeline as to how quickly must a company respond, and what's the exercise from there?
Yeah, it's a great question. I think the first thing to say is that this is should be thought of differently to, say, a takeover approach, which for a takeover, it's governed by the takeover codes. Targets nowadays have tools available to them to very tightly constrain the timetable post approach if the approach is unwelcome. By contrast, an activist is but a shareholder on one measure and can sit there patiently for as long as they want. So it's very important to have the right mindset. Dominic has already used the word engage quite a lot, and that is very much the way we advise our clients to think about the initial approach. Oftentimes the words attack and defense are used, and I understand why people do that, but I do think it's the wrong mindset to have from the outset. People may have a takeover defense manual on their shelves. We have one that we prepare for our clients for activism situations. We call it an activist approach guide. We're trying to steer people away from the attack defense mindset. And how you react to that first approach very much depends what is in that approach. The market is much more sophisticated here in the UK than it was 3 or 4 years ago, partly through familiarity. There's been a lot of activism over the past few years, and people on both sides of the fence have become more sophisticated and mature in how they think about it. Many campaigns now, it's a bit like the iceberg metaphor. Many, if not most, campaigns are concluded in private below the watermark. The stuff that you see that's all juicy in the press above the watermark represents the minority of shareholder engagements that could be sort of deemed activisty, and that is the best outcome. If you as a board can receive an approach and engage with the activist in a constructive manner and reach a consensual outcome that is non-public, that I would argue is the best use of everybody's time and money and a good exercise of your fiduciary duties. Sometimes that's taken outside your control because the activist doesn't like what you say or may go public from the outset. But it's very rare nowadays that you see the activist ring the doorbell and sort of punch you in the nose straight away. Actually, the activists are more sophisticated than they used to be, and they want to engage privately and reach a private outcome. That's a better result for them as well. The outlier is possibly the smaller funds. They might be in fundraising mode. They want to create quite a lot of public noise, which is why it becomes very important to understand who you're dealing with. But that's the very first step, having engage as your mindset. The other phrase I would say is don't panic. You are not alone. Many of your peer group will have already dealt with an activist. It's a well-trodden path. To Charles's point, having the right advisors alongside you who will have seen this 10, 15, 20 times already will set things off in the right manner. And with proper advice, listening to the activist's ideas, as I say, most times you can affect a consensual outcome without the noise of a public campaign.
Yeah,
I might just add to that, if I may, on the point that your peer group might have been targeted. Given the rise of activism across Europe, we're often seeing cases where there is a chairman, a director, a CFO who has experienced activism before. And it's really important not to assume that what you've seen before is what you'll see again. To Tom's point, there are many new funds, smaller funds that behave in different ways. If the kind of where the activist is in its fundraising cycle is slightly different to before, and indeed, just because you're a different company and there may be a different thesis, the whole approach, or if it becomes a campaign, may play out differently. So it is important to kind of go back to first principles every time. And I completely agree with the point on engagement, but I would also add a point around responsiveness. Responsiveness does not necessarily mean that you are immediately coming back with a fulsome reply to an activist request, but both with shareholders in general and with activists saying, we've seen this. Let us just kind of, you want to meet, let us check our diaries, let us come back to you. Make sure that everyone knows you are treating and kind of outreach with the respect it deserves. But that doesn't mean you have to rush to a fulsome reply. So there is a kind of balance to be trod between giving everyone the respect and taking the time not to panic and to do your research.
Thank you. And Charles, so at this point, I guess the board, you mentioned take on advisors. If you haven't done already, or you're not regularly doing it, this is, well, what's your advice as to what you have to start doing with share registers and contacting shareholders? And certainly, I'm just thinking of Reckitt. If you are big brands, attract more press, big corporates, you are going to have bigger, multifaceted share registers. What's your advice as to them? What would you do in the immediate response as to once they get approached?
Well, I mean,
100 type company.
Yeah, we've kind of talked earlier about the importance of understanding the register, and obviously it goes without saying that that's got to be ramped up as rapidly as possible. Because one of the other things that could happen is that you might have more than one activist on your register looking for different things. So kind of understanding what their previous behavior has been like, the kind of campaigns and their public demands that they've made in the past, being prepared for that is quite important. And once you start getting the communication from them and you're engaging with them, you might find that there might be a call, a demand for return of capital, or it could be being sold or something like that. So it just goes back to, again, as Dominic says, communicating not just with the activist, but with your shareholder base and understanding your shareholder base, so you really get a strong feel for where the support is. And it may be, once the campaign goes public and you've got a couple of different demands out there, or even one demand, that in fact you realize that actually this is the way that your investor base would like the company to go. So then you have to have that kind of communication line open with both your investors and the activist. I mean, the other things I think which are worth considering, Mel mentioned it, don't rely on previous experience, but is always quite important, I think, to have someone with experience. So understanding all of the board responsibilities in a situation like this, and making sure each of those board members understands what their role is important. And then, as once you get through, I mean, really, you need to be, when I say hiring advisors, it's obvious why we're all on this panel here. You need a legal advisor, you need a financial advisor, and you need an advisor like ourselves, where we can help with our understanding of global investors and activist investors in particular. So having all of that as together is so important. Otherwise, it'll run away from you.
And Charles, for those that aren't familiar, if you're a FTSE 100 business and you suddenly need to do a complete overhaul of your share register and everything else, what's the sort of timeline? How quickly does one get these back? Because you can't make your plan until you know who you're going to go and talk to.
Yeah, so most companies obviously run a shareholder analysis on a monthly basis. It may not be the most detailed analysis that you can have, but it's something to work from. And you can combine that with a cut of the register, which you can request obviously from your registrar. And as Tom points out, serve 793 notices on nominees who, those nominees legally have to respond, and most of them will respond fairly rapidly. But you can get a very full register analysis within a couple of weeks. And when I say a couple of weeks, that would include retail investors as well. If you're going all the way down through if it's a company, as an example, which has got a lot of indirectly held retail shareholders through private client broker platforms or wealth managers, etc. Serving notices on them does take a little bit longer to come back, but you can build that picture really quite quickly.
International holders?
Sorry?
International holders, I'm assuming that half the register is not UK based.
Yeah, that's obviously depends where. that they're held, and really whether they're going to pay any attention to well, they won't pay any attention to a 793 notice. But again, if you've been given the data from the register, you should be able to unpick that and work out which are the US funds, which are kind of continentally based funds, etc. And you can get to those responses pretty quickly.
So we got to the stage that you've absorbed that the activists have made their requests for a discussion with the business, some of which I guess you're going to agree. Well, boards may agree with, or they've already covered this off. If a good board probably is looking at a lot of these things. What's the process afterwards, Amel, for engagement? How do you as a business, how do you start to control the timelines? How do you start to bring the activists on board so that I guess at this stage you don't want it to go public? Let's just assume it's still a discussion between an activist who's written to the chairperson. Well, what's the next stage? And these things, I mean, they can last for months, years, I guess, in some cases.
They certainly can, and they can become a real distraction for management teams and boards. I think the key guiding principle here is the same as Tom was referencing earlier. It's about engagement, but you have to manage that engagement carefully. You can't give into this expectation that chairman or senior board members will be available as and when the activist needs to see them. So firstly, it's about fielding the right person for each meeting. Is it an introductory meeting where they're just trying to get some information about the business? What are the questions they'll have? Getting an agenda set in advance will help you understand who should be at that meeting. We shouldn't always be giving, for example, the CEO for a meeting if it's more of a CFO topic. And having that sort of balance of interaction, being able to give them multiple touch points within the company as and when suits the discussion and suits the company is very important. The other thing is thinking about your regular interaction with shareholders. At certain times when the discussion has gone on for a very long time and there's maybe not a particular thesis being pursued or a particular rush to the activists' engagement, it may make sense to defer that until your regular way engagement after results, so that you can have a kind of a more open conversation outside of a closed period. I think it's difficult to talk about this in complete generalities, because depending on the activists themselves, where we are in the calendar for the company, the answer will be different. But the important thing is to understand that when someone is asking for engagement, engaging doesn't mean engaging in the way that specifically they have asked. It's your tool and within your power to decide who they see and when. Activists love to add this idea of urgency. I think we mentioned with the first outreach, there's stories of it coming as someone is getting on a plane, as someone is, walking their dog in the morning, and we didn't want you to be alarmed, but at 7:30 we're going to release a letter. I mean, these are all extreme examples. As has been mentioned before, activists have really become much more sophisticated in recent years. But there is a sense of urgency when you see an activist email you, even if it's not coming from them and it's just coming from a level of panic that we're obviously advising that you don't take on board. So mapping out engagement, you can be kind of constructive with an activist without just saying yes to all of their requests. So taking your time to understand what they're asking for, what they'd like to discuss, and then who in the company is best positioned to be able to respond to that, as well as probably not giving out the most senior people for an initial meeting would be the key things that I would recommend.
So how much would you sort of be using your advisors? This is in coordination, or does first response come from your I guess they'd probably be your legal advisors at this stage, or your corporate advisors?
Well, we would always recommend that the responses are from the company. An activist is a shareholder, and that relationship between the company and the shareholder is the most important. We will advise the company how best to respond or what we think might be appropriate. But from the first outreach to the company, all of the advisors will be giving perspectives on the nature of the activist, what they have done before, how we expect them to behave typically, the tools in their arsenal, particularly any information we have about the individuals they're proposing for a meeting, how we understand them to behave typically, how we've seen them in previous situations, and then, of course, diving into the thesis and the potential vulnerabilities themselves. For example, if the activist says, we'd love to talk about your, X division that is, blue while all your other divisions are green, or what have it, we will be able to talk you through some key points, because hopefully we've already done that vulnerability analysis, and we want to give you talking points so you're ready to reinforce why it's such an important part of your strategy to have that business as a whole. And Tom and his team will be explaining, hopefully, how it's a very tricky long-term thing to unravel this division, and wouldn't be worth it or cost-effective as it is. But we're all involved right from the outset, I would say.
And Tom, as constantly we're reminded of, is that there is a different process of how you need to engage, because they are shareholders. But in the view of treating all shareholders equally, how much of a discussion needs to be aired? What should be expected as to whether you, as a board, do you feel like you need to publicise your response, or do you want to try and keep as much private for as long as possible?
Well, I think there's two questions in there. One is, how much should you speak to the activist as a shareholder, and second of all, do you try and keep it public or private? The second one, I think, is quite easy. 9 times out of 10, you as a board are probably motivated quite strongly to keep things private for as long as possible, and done correctly and properly, that can be achieved. In terms of whether you should engage, as Emel says, it's very rare that you deal with an activist who isn't actually a shareholder, but technically they might not be a shareholder, they might be a CFD holder, but you should treat them as a shareholder, because they can pretty easily convert their CFDs into shares. And so you should be looking to engage with them, as Emel says, in the right way, with the right cadence, with the right people. And that doesn't mean too much engagement either. You also need to think quite carefully about what information you are sharing with the activist in response to what they're asking. Is it appropriate to wall cross them to discuss a specific proposal? The proper purposes for wall crossings are pretty narrow. We saw with the FSA sanction summer of last year, it was reclarified how narrow that proper purposes exemption is. So thinking about that pretty carefully, understanding what it is that they want to achieve, what information they're asking for, and working with your advisors to devise the correct response is what I would suggest is the right approach.
Okay, and then Dominic, from a point of engagement, again, in your experience when you've dealt with this on this, what did you find works best? What's frequent engagement, consistent engagement?
Yeah, in our case, we actually had a meeting booked with the activist the following day. So I guess from an engagement perspective, that was quite helpful, because we could address some of the things in conversation. I would advise, if you had received a letter, I would respond to that letter after doing the necessary analysis that you need. Respond to that letter with a formal letter back to the activist. I'd say at the end of each engagement, make sure that you straight away prepare for the next one, and set the next one up straight away, so that the activist isn't left kind of wondering when that might be. So you get that in the diary straight away. And yeah, I mean, be polite, respect the views. A lot of them, may well be very valid and something the company should be thinking about. So take those views on board. And as I said, respond more formally to maybe some of the governance issues that are identified alongside, other issues. In our case, it was, one of the issues mentioned was the level of ownership of shares at the board level. Because it came from a US investor, there were some nuances, and there's some cultural differences in those markets in terms of, in the US it's encouraged that, non-exec directors actually own shares, whereas in the UK it's not frowned upon, but you wouldn't,
Yeah.
you know, it's kind of, it's a different culture.
Yeah.
So, you know, we did a lot of analysis. We looked at the average holding on the FTSE 250. We know we collated all of our analysis, and those were the bits that we responded to in a formal letter. Whereas the face-to-face discussions, you know, they should be quite regular. And once you get to the end and you're in a good place, you know, sort of make sure you kind of formally end those discussions. In our case, the activist went away happy because we listened to him, and we actually did a lot of the things that were suggested. But then they did appear back on the register about a month later. But you know, we'd got the activist to a place where he could see our point of view. He was happy that we were, you know, acting upon some of the suggestions. It was something that our other shareholders told us that they'd been thinking about as well. But I guess we had quite a lot of quick wins at our disposal because we were already internally actioning a lot of these things anyway.
Yeah.
But I think, you know, and I've said it already, but agreeing up front a structured way of engagement going forward, as I said, out of the public domain is kind of what you want to aim for, really. You get that agreement up front. It becomes a much more constructive engagement.
Yeah. Charles, last question for you, just before I sort of open it up to some questions from the audience, as we're scheduled to finish it at 2. But we're talking about engagement. We're kind of assuming that engagement ends well. If it doesn't end well and it's been pushed for a proxy vote, what are the likes of Maurice O'Darley? What do you then come in with at this stage as to? I guess it's like other proxy voting. There's a lot of desperate phone calls being made to shareholders to see which side they're going to fall on. Is that right?
Well, the kind of feedback loop with the shareholders is probably the last thing that you do. So initially, obviously, you've got to understand what the demand, you know, the public demand is, what the campaign looks like, what the timing looks like. So you have all of the advice in terms of notice of meetings or whatever it is. So let's say it's a requisition meeting to replace the board. So the company should be with its advisors basically assessing the board and then putting together the case for the company and the case for those board directors, because that is going to go in front of the investors for them to vote on. So the board definitely needs to work on that. The board will also then need to work on scenario analysis, working on rebuttal letters as an example. So making sure that, because you have to assume that the activist is going to be putting loads of stuff out in the public domain, and the board has got to be in a position where it can actually counter that, or at least comment on that. So that scenario analysis initially is really important, because what you don't want is massive delays and giving the activists time for their messaging to sink in. So there's all of that kind of preliminary work that the board would need to do. Then combine that, obviously, on the first part of it, doing that analysis on targeting investors, also understanding which investors might be aligned to which proxy advisors. We haven't really talked about that yet, but in a public campaign, there is a vote, assuming there's a vote, and the proxy advisors are going to make a recommendation, and they will be getting inputs from both sides. So again, rebuttal letters might be necessary from the corporate side if the recommendation is positive towards any of the activist demands, but it's also understanding which investors are aligned to the recommendations generally. And there's all kinds of discussion out in the marketplace about alignment to proxy advisors and whether investment managers actually do anything independently. Of course they do, and they take the data from the proxy advisors, and they use that in the way that they then come out with their conclusions. But that is important, and then understanding who pulls the triggers within the investment community. Is it the fund manager or is it the stewardship team? So obviously, if you're looking at passive investors who might hold a large chunk of the register, they don't have any active fund managers. So, but you need to understand what their governance policies might be, what their history's been in these kind of situations, and how to potentially engage with them. And it's not a simple exercise. And groups like ourselves obviously are, talking with the stewardship teams on a daily basis, so we understand who to go to. So it's getting the advice on that. And then when it comes to the vote period, then yes, it's engagement. Allowing your proxy solicitor and maybe your financial advisor to engage with the key investors, or maybe even down throughout the register, and receiving that feedback. So there is the potential then to use that feedback, obviously, to put more communication out in the market, more messaging, whatever is required to maybe turn some of those investors or explain the situation. And then, making sure that if there are certain investors who have got issues, that, from that feedback loop from the proxy campaign, then the corporate is actually engaging with those investors directly. To see if they can change their minds, and then all of that comes together to the vote process, and then whatever the result is after that. But that is kind of the process as we go through it. There's lots of kind of things that could cause problems as well, but in terms of the plumbing, etc., with their votes getting lost or whatever it is. But generally, the proxy solicitor's role is to mobilise those votes and make sure those votes land.
Thank you. So I'm just going to open it to some questions that we've received. So just sort of run through some of these, and people in the audience, and please do ask other questions as you're going. So there's one here. There's a question between. So at what point is the board responsible for discussing more widely with other shareholders what an activist requests? So what point is it? I guess this is the public info. Tom, what are the legal ramifications on that? So does the board need to? Well, I guess you can't give the activists inside information. I guess that's unless you actively make them inside to kind of like curtail their ability to do anything. But are you obliged to tell other shareholders what the activists did want?
I think the first thing to establish is what is it that the activists asking or proposing or threatening to do, and is any of that in and of itself price sensitive? Because if it is, then absent a reason for delaying disclosure, you as a company have an obligation to notify the market. And the most obvious example of that is if you received a requisition to convene a shareholder meeting, or potentially even a threat by somebody that you think actually has the right amount of shares to put forward that requisition, and you have to weigh up whether what you're in possession of is announceable. So that's the first thing. Most times, actually, it's probably not announceable. If they send you a private letter saying, "Here we are. This is the number of shares we hold. Here are a few ideas for how we think the company could be run better, and can we have a conversation?" That most likely is not announceable. But again, it needs to be thought of carefully. I would say a letter from Elliot, to pick a name, for example, should be viewed in one light. A letter from a first-time small activist should be considered in another light. But there's no bright lines there, so it's important to discuss with your advisors around all of that. And then the next point is coming back to what is it that they're asking. Is there anything in there that you think you ought to go and speak to other shareholders on, not necessarily because you're guided by some sort of fiduciary duty to do so, but actually you want to get the weight of their opinion. You want to understand whether they support what the activist is proposing. Maybe the activist is suggesting that some of the other major shareholders have already been spoken to by the activist and are supportive. I would say, and others on this call probably are more expert than me on this, that maybe you should be ringing around your shareholders to test some of those theses and the ways of support lies behind it.
Yeah, thank you. So another question here is Charles, can you make an activist declare their holding?
It's a good question. I'm not sure I know the answer to that one, actually, Fraser. I mean, if they've got a declarable, disclosable stake, then obviously, they have to declare it. But if they're sitting below a disclosable position and are sitting in a CFD, then no, I think it's really difficult to actually force them to do it, because you can serve a 793 on a prime broker. They won't respond. They will go, they will basically protect their client interest. So you'll never, I think, very, very unlikely get a response from a prime broker about who they're holding, who their clients are, who are holding the position in the stock, ultimately holding that position in the stock, whether through
the market knowledge is
Can I just jump in there, because from a legal perspective, 793 is actually quite a powerful tool, and there's the theory versus Charles's practice, but maybe if I could bridge that gap, 793 makes it a legal requirement to respond if you've received that 793 notice. So if it goes through the nominee in the chain of custody to the prime broker, and the prime broker says, sure, we hold those shares, they can't turn around and say, but we're not going to tell you who we hold them on behalf of. First of all, that's an offence. Second of all, there's pretty strong powers of disenfranchisement of those shares for somebody that fails to respond fully to a Section 793 notice. Now, the nuance here is that Section 793 notices only apply to what's called an interest in shares, and a pure cash settled CFD. I think most people in the city, legal advisors, would regard that as falling outside the definition of an interest in shares. So if the prime broker is holding a block of shares to underpin a CFD that their client holds, then they can legitimately say, we're not going to tell you. But I think if they hold physically settled CFDs, or indeed shares on behalf of a client, they should be responding under threat of disenfranchisement.
Okay, thank you. Just two more questions then. One, so Emil, I'll just ask you this one. So how do you differentiate when is an activist an activist versus just a hedge fund?
I think I'm going to broaden that. When is a shareholder an activist versus just a shareholder? And I think that line has become increasingly blurred. So it's a very apt question. I think what we're seeing is a growing rise of active shareholders considering themselves as share owners, and taking an increased role and believing they have the right to take an increased role in the direction of the company. So I think for me, the real issue starts when you have a long-term shareholder on the register for 10 years, and they've always been, you might call it a difficult meeting, prodding a little bit. Why is this here? We're not really delivering on the margin targets, that sort of discussion. And it starts to escalate into something that every meeting is like that, or they're engaging with you out of the course of an ordinary engagement, asking these sorts of questions. I think that's the biggest trigger. When you see something out of pattern, you should start thinking that they could potentially agitate publicly, or indeed more privately, if they're asking to see board members they might not ordinarily engage with. And the other thing that's really important to see is the level of engagement between shareholders, or traditional long-only shareholders, and fully formed activists. So I think we've referenced it a little bit. Activists will go to shareholders to canvass their opinion, but actually, within the ecosystem, it is very, very possible, and I wouldn't go so far as to say common, but it definitely does happen, where long-only shareholders contact activists. And say,
I'm going to cut you off. I've got one more question. Sorry,
go for it.
And for Dominic, just going. Should you welcome activists onto the board?
Oh, yeah, that's a very good question. I've not personally been in that.
I've only given you 30 seconds to answer it, so you're safe there.
I think you should. I mean, look, if the activist is talking maybe to the chairman or the CEO, and they will relay that conversation to the board. There's no reason why the board shouldn't engage with the activists. I think there's more downside to not doing so.
Right.
Can I just offer an extra angle on that? So there's a knee-jerk reaction to letting an activist on the board, but actually it's 1 seat out of 10, say. So on one measure, how much harm can they do? I mean, I apply a bit of caution to that, but how much harm can they do? When they go on the board, they can't trade. So you put them offside. And you also, as a quid pro quo for putting on the board, sign a relationship agreement. And if you're well advised on the company side, you will try and tie the activist up for the duration of their time on the board in various ways. So it's not necessarily a bad idea. Thank
you. Well, that brings us to the end of the allotted time. For those in the audience, do feel free to approach, pick up the phone to any of us on the panel. I just leaves me to thank Dominic, Charles, Tom, Emil for your great insight. It's just what is very interesting about the topic is that there is a playbook. There's only so much as to how activists can do it, but then each company is very different, and you can't just take this off the shelf. You've got to manage it all of what is specific to the company and have your own ways of managing it. So I think that the first lesson is be prepared. It's much better to have a plan and not use it than to not be prepared. And then as we find out, if the activists do build momentum, it can go in a very different direction than what the board might want. So with that, I'm going to close the session. Thank you all very much, and we welcome your follow-up. Thanks very much. Bye-bye.